Henry Kravis, a dominant force in the world of finance and private equity. In this video, we will learn how he started his career, built his empire, and became one of the richest and most powerful men in the world. Henry Kravis was born on January 6, 1944, in Tulsa, Oklahoma. As a child, Henry was curious and ambitious and enjoyed playing board games that required logic and strategy. Henry went to some of the best schools in the country, where he did well in academics and sport. After graduating from Claremont McKenna College at the age of 23, Henry moved to New York City, the financial capital of the world. In New York, he joined Columbia Business School, one of the top business schools in the country, where he got his MBA degree. During this time, he changed several jobs. First, he worked as a trainee at Smith Barney brokerage firm, where he learned about the stock market and securities trading. Then he worked as an analyst at Morgan Stanley, where he learned about mergers and acquisitions and corporate finance. Then he worked as a consultant at McKinsey & Co. consulting firm, where he developed skills in business strategy. At the age of 25, Henry joined the corporate finance department of Bear Stearns Investment Bank. Alongside his cousin George Roberts and under the management of Jerome Kohlberg Jr., he began working on what they called bootstrap acquisitions. This is a type of acquisition where the acquirer uses the assets of the firm it is trying to buy as collateral to finance the acquisition, much like an individual buying a house with a mortgage. Just as a mortgage is secured by the value of the house being bought, the debt incurred in a bootstrap acquisition is secured by the assets of the acquired business. Unlike a house, however, the bought-out business generates income which is to be used to service the debt incurred in its buyout. In essence, the acquired company pays for itself. After such acquisitions, the management of the company would usually remain unchanged, but the company would undergo restructuring and performance improvements. It would then either be sold to another buyer or made public through an initial public offering. In 1975, Kravis, Roberts, and Kohlberg closed one of Bear Stearns' biggest deals in its history when they acquired Income International, generating $950,000 in fees for Bear Stearns. But soon the scene changed. Bear Stearns considered bootstrap acquisition as too risky, and whenever Henry, George, and Jerome would try buy a new company, they would struggle to obtain financing for the deal. They also did not have much control over how the companies were run post-acquisition, as they had to share the decision-making power with the bank management who often disagreed with them. They felt frustrated and constrained by the limitations imposed by Bear Stearns. This pushed the trio to take a big gamble. That is, to leave the bank, start their own firm, and focus on LBOs. With modest savings at hand, Henry and George joined forces, contributing $10,000 each, while Jerome Kohlberg's substantial input of $100,000 became a cornerstone. This marked the birth of the Kravis-Kohlberg-Roberts Enterprise, or KKR, a bold plan to do leveraged buyouts that was a new and untested strategy at the time. But to execute their plan, they needed more money. They tried to raise their first fund of $25 million from insurance companies that they had worked with before. But they soon realized that they had a problem. The insurance companies wanted to have a say in how the companies that KKR bought were run. They wanted to be part of the investment committee and have veto power over any decisions that KKR made. This was unacceptable for KKR, who wanted to have full control over their investments and the freedom to make changes without interference. This was also one of the reasons why they left Bear Stearns, and they did not want to put themselves in the same position again. They were stuck. They had a big idea, but no money to make it happen. They needed a solution and fast. One night, while having dinner at Joe and Rose restaurant, Henry and George had a breakthrough moment. Instead of seeking institutional investors, they decided to target high net worth individuals who would be more willing to trust them and give them autonomy. They proposed to 8 individual investors that they commit $50,000 each year for 5 years, in exchange for the option to participate in any of KKR's deals. If they decided to invest in a deal, KKR would get 20% of the profits. This was a brilliant solution, because it secured a steady flow of capital and gave them the flexibility and authority that they wanted. It also created a loyal and motivated group of investors who supported KKR's vision and shared their success. With this innovative fundraising model, they launched their first fund and started making deals. KKR's first deals were mostly small companies that were family-owned or in financial difficulties. These companies had low valuations, stable cash flows, and potential for improvement. KKR saw an opportunity to buy these companies at a bargain price, turn them around, and sell them at a profit. Some of the examples of these deals were AJ Industries, a manufacturer of recreational vehicles, and Cobbler Industries, a maker of women's shoes. To raise more money, KKR had to rely on bank loans and junk bonds. Junk bonds were high-risk, high-reward debt instruments that offered high interest rates to attract investors who were willing to take the chance on companies with low credit ratings. KKR worked closely with Drexel Burnham Lambert, an investment bank that pioneered the junk bond market and was led by Michael Milken, a controversial financer who later became known as the Junk Bond King. But soon KKR's success with its first deals attracted institutional investors. In 1978, KKR raised its second fund of $30 million from pension funds, insurance companies, and endowments. These investors were more sophisticated and experienced than their individual investors, and they gave KKR more credibility and access to larger deals. As KKR grew its fund size and reputation, Henry's attention caught the conglomerates. These were giant public companies that had diversified into many different businesses that were not related to their core competencies. This was a common trend in the 1960s and 70s, as companies tried to expand their market share and reduce their risk by acquiring other companies in different industries. However, this strategy often resulted in inefficiencies, conflicts, and poor performance, as these companies became too complex and difficult to manage. Henry realized that these conglomerates would create more value if they were broken down into smaller and more focused businesses. If KKR could buy these companies, it could sell off their non-core assets, improve their profitability, and then either take them public or sell them to other buyers at a higher price. This was the opposite of what conglomerates had done, and it was called a reverse merger. In 1979, KKR made a breakthrough by completing the first buyout of a major publicly traded company, Odai Industries, a diversified industrial conglomerate. The deal was worth $355 million and was financed by a combination of bank loans, junk bonds, and equity from KKR and its investors. This deal established KKR as a leader in the LBO industry and attracted the attention of the media and the public. KKR continued to pursue LBOs of large public companies in the early 1980s, such as Fred Meyer, a supermarket chain, Safeway, a grocery retailer, Beatrice Companies, a food and consumer products conglomerate, and Storer Communications, a broadcasting company. But KKR's biggest challenge was yet to come. In 1988, KKR faced a fierce bidding war for RJR Nabisco, a giant food and tobacco conglomerate that was led by a charismatic CEO, F. Ross Johnson. The deal also attracted other bidders such as Forstmann Little & Co., another private equity firm, and First Boston Corporation, an investment bank. The bidding war lasted for 6 weeks, from October 20th to November 30th, 1988. During this time, all the parties involved increased their offers and tactics, trying to outbid and outsmart each other. The deal became the largest LBO in history at the time, which we will cover in detail in our next video. Until then, please subscribe, leave a like, and let us know your thoughts in the comment section. Stay tuned. Cheers.